Welcome to Runway Radar Roundup, your weekly touchdown on the hottest headlines in commercial aviation. I'm your host, Trevor G., soaring through the latest developments from the skies, all curated from the sharp insights at runwayradar.com. Buckle up for a jam-packed episode featuring soaring profits in Europe's low-cost carriers, bold fleet expansions, game-changing acquisitions, and the innovations redefining the industry. Let's taxi to the runway and launch into the highlights. In our first story, we look at how Europe's leading low-cost carriers fared in Q2 2025. Ryanair, EasyJet, and Wizz Air showed mixed results amid robust travel demands but operational hurdles. Ryanair stole the show with a net profit €820 million, a staggering 128% year-over-year, thanks to a 21% fare hike and tight capacity control that kept load factors at 95%. Their revenue climbed 20% to €4.34 billion, positioning them as a standout performer. EasyJet wasn't far behind, however, reporting a €286 million pre-tax profit, up 21%, with revenue rising 10.9% to €2.92 billion. However, they grappled with air traffic control disruptions and rising costs, maintaining a solid 90.2% load factor, while leading on their holidays division for an €86 million boost. Wizz Air, on the other hand, saw revenue grow 13.4% to €1.43 billion, but operating profit dropped 40% to €27.5 million. Their net profit hit €38.5 million, largely from non-operating gains like Forex, marking over 3,100% jump. Fleet groundings, over 40 aircraft due to engine issues, hurt them, leading to market retrenchment. Looking ahead, Ryanair's discipline gives it an edge for returns, EasyJet's diversification helps buffer risk, and Wizz Air needs operational stability. This quarter signals a pivot from aggressive growth to smarter cost management in the LCC space. In a strategic pivot, Air Lease Corporation has canceled its order for 7 Airbus A350F freighters, as revealed in their Q2 2025 earnings. This move, from a 2021 Dubai Airshow deal, frees up over $1 billion in capital amid cargo market uncertainties, program delays, and unattractive pricing. Deliveries slated for 2027 to 2028 offered no short-term revenue, so ALC is redirecting focus to high-demand passenger aircraft. The air cargo sector is softening. IATA's June data shows just 0.8% year-on-year CTK growth, down from May, with geopolitical issues hitting Asia and North America routes. Cargo load factors fell to 45.5%, freight rates dropped 2.5%, and rising fuel costs add pressure. Increased belly hold capacity from passenger recovery reduces freighter needs. Airbus remains bullish on the A350F's efficiency against Boeing 777-8F, but adoption may slow. ALC's shift emphasizes flexibility and volatility, prioritizing passenger fleet expansion for better alignment with client demands. Asia's air cargo scene is transforming with key acquisitions. Japan's ANA finalized its buyout of Nippon Cargo Airlines on August 1, 2025, via a share exchange with NYK, creating Japan's largest integrated airline. This merges NCA's Europe and US routes with ANA's network, combining fleets of 6 767s, 2 777s from ANA, and 8 747-8s from NCA, ranking them 14th globally by cargo weight. CEO Koji Shibata notes enhanced capabilities for special shipments. In South Korea, Air Incheon rebranded as Air Zeta after acquiring Asiana's cargo arm for $338 million, mandated by the Korean Air Asiana merger to curb monopoly. Now the second largest, Air Zeta operates 15 freighters on 21 routes across Asia, Europe, and the Americas, with 1,000 staff in Incheon. CEO Kim Kwon-sik eyes e-commerce and specialty freight to challenge Korean Air's 67% share. These deals drive consolidation, boosting scale and innovation while maintaining competition through regulation. Israel Aerospace Industries hit a milestone with its 777-300 ERSF Big Twin freighter, successfully transporting a Rolls-Royce Trent 1000 engine in August. Using a Collins cargo system, this demo proves handling of oversized loads, like the 2.8-meter fan Trent 1000 for Boeing 787s. As STC approval nears by late 2025, after first flight in March 2023, the GE90 powered jet offers 100 metric ton payload, making it the first 777-300 conversion. Partners include AerCap and Kalitta Air, with global sites like Etihad Engineering. It addresses rising engine logistics needed post-COVID, enabling new carrier models. Competing with A350F and 777-8F, it provides 777F-like capacity at lower cost and faster delivery, ideal for integrators in tight wide-body markets. Virgin Australia is opting for caution on wide-body orders, using a wet lease deal with Qatar Airways to test international waters. CEO Dave Emerson at the CAPA Summit explained that this 5-year pact for Doha flights lets them gauge demand, cost, and profitability without heavy investment. It could lead to dry leases later, minimizing risk and volatility while focusing on domestic growth. They're adding 16 aircraft this year, 12 737 MAX and 4 E190s, to replace Fokkers, despite supply delays prompting temporary leases. Post-IPO in June, reducing Bain's stake to 40%, Virgin finances support this measured approach, potentially delaying wide-body buys for years but ensuring data-driven sustainability. Vueling, IAG's all-Airbus LCC, is diversifying with up to 50 Boeing 737 MAX jets to cut supplier dependency and boost bargaining powers. The MAX 8's advantages are lower seat mile cost, more seats, better fuel efficiency amid high prices, and greater range for varied routes. This challenges Airbus's IAG dominance, urging improvements in reliability, like A320neo engines, in support. Boeing gains in the LCC arena with cost edges. Broader implications are that fleets are prioritizing flexibility and competition, spreading fixed costs, reducing maintenance, and expanding networks to keep fares low and profits high in evolving low-cost travel. 5 years on from KLM's Boeing 747 retirement, accelerated by COVID, we reflect on this milestone. Amid global shutdowns, KLM parked more than 200 aircraft, losing 25 million euros daily. The last passenger flight was by a 747-400M Combi, ending nearly 50 years. Briefly reactivated for cargo in 2020 to haul medical supplies, they were fully retired by October of that year. This echoed trends. Qantas shifted to 787-9s and A330s. BA phased out by mid-2020 for A350s and 787s, while Lufthansa keeps 747-8s due to delays. KLM now embraces efficient twins like 787-910 and plans A350s for sustainability, honoring the 747's legacy while eyeing a modern future. FL Technics is bolstering its MRO network with the new 2,041 square meter wheels and brake center in Bergamo, Italy, its fourth, joining Vilnius, Budapest, and Hanover. Targeting Southern and Western Europe, it cuts turnaround times, enhances AOG responses, and supports sustainability by reducing shipping. Employing 160 technicians, it grows their more than 3,000-person workforce for regional efficiency. Plus, a Honeywell partnership as channel partner enables engine and APU distribution, MRO, and seamless OEM services for Bazov. This dual expansion, geographic and integrated, positions FL Technics as a European MRO leader, minimizing downtime and boosting airline ops. Etihad Airways set a record in July, taking 5 aircraft, 2 Boeing 787s for long haul, 1 A350-1000 for intercontinental, 1 A320, and its first A321LR with premium features. This pushes their fleet to 106, averaging 8.7 years, under Journey 2030 for efficiency and experience. CEO Antonio Neves calls a key for new routes. Abu Dhabi's Zayed Airport handled 5.5 million passengers by June, 93,858 movements, and 344,795 tons of cargo. New partnerships added 16 destinations, solidifying Etihad and Abu Dhabi's global aviation surge. Riyadh Air is gearing up for 2025 launch with a long-term EPCOR deal for APS 5000 APUs on its Boeing 787s, including MRO, modifications, and predictive prognos support for reliability. They also ordered 60 Airbus A321neos, adding to 72 787s for 132 total, fuel efficient for more than 100 destinations by 2030. This supports Vision 2030's tourism and logistics push, with digital perks like high-speed connectivity. Leaders like CEO Tony Douglas and Airbus's Christian Scherer praise the efficiency, marking Riyadh Air's rise as a premium tech-savvy hub. Swiss firm Destinus acquired Dedalian for $223 million on August 5th, boosting Europe's AI aviation. Dedalian's ML avionics enable autonomous flight in GPS-denied areas, with camera sensor tech tested on helicopters, pursuing EASA FAA search for drones and taxis. Destinus, shifting to military drones post-Aerotronic Spy, integrates this for surveillance and AI co-pilots, aligning with Rearm for defense self-sufficiency. Founder Mikhail Kokorich eyes certification breakthroughs, transforming autonomous flight amid global rivalry. That wraps up this week's Aviation Weekly Recap from RunwayRadar.com. From LCC profits and leasing triumphs to fleet milestones and AI advances, the industry is buzzing with innovation and strategy. These stories highlight how airlines and lessors are navigating challenges for a sustainable future. Stay tuned for more updates, and as always, keep your seatbelts fastened and your tray tables up. Thanks for joining me, and I'll see you next week.